Hi, my name is Ashton. I'm Director of Business Strategy here at Tax Hack Accounting Group. And today on the line, we have Ryan Moss, who's our M&A specialist here at the firm. We're going to get into some of the tax implications and the things that you should be considering when going through a merger and acquisition. So Ryan, to get us started off, what are some of the things from the tax side of the house that you should be thinking of when you're about to go through a merger or an acquisition?
Yep, it's a great question, Ashton. It's a very broad one. I think the primary driver from a tax standpoint is, obviously for a seller, how much tax am I going to pay? Buyers have, many different motives for entering into a transaction, but as we'll get into, a lot of that, has tax implications in and of itself. So if we just look at a couple examples, of why the tax classification of the target and the purchaser matter. And we could start with a company that is taxed as a C corporation for U.S. federal income tax purposes. C corporation has there's a lot of different code sections in the Internal Revenue Code that are applicable to mergers and acquisitions and other types of transactions. So if we just step back and look at Section 382, Section 382, anytime there's a greater than 50% ownership change in the stock of a C corporation, it limits that corporation's ability to utilize its historic net operating losses. So as you can imagine, and this is just one example, if you've got a buyer who's buying 100% of a C corporation that has historic losses that are carrying forward, the value of those losses might not be as high as they were had a ownership change not occurred. Another example from a seller perspective, especially, is Section 1202, which allows you to potentially exclude up to $10 million, the greater of $10 million or 10 times your basis in the stock, if the C corporation meets all the requirements of Section 1202. So, and that's just one entity type, being a C corporation. We can also get into partnerships and how partnership interests are treated when they're sold versus purchased. S corporations. I know there's a lot of small businesses out there that are S corporations, and this would be a good topic to discuss as well. Generally, a purchaser is not going to be an individual, and so if you get into the private equity world, it's very rare that you have an individual just going out and buying a company. And the reason that's relevant for an S corporation is because an S corporation can only have certain types of shareholders, and those are generally individuals in certain types of trusts. So if you have a partnership who's coming in and wants to acquire your S corporation, chances are they are not going to want to purchase the S Corp stock directly, because if they do, that S corporation will default to a C corporation. So you have to be an eligible shareholder, and usually what we see is some type of pre-transaction reorganization of the selling S corporation so that does not happen for the purchaser. And then, you're always going to have, disregarded entities. So for example, a single member LLC. So this would be, maybe a seller who is going through a transaction and they report all of their income and loss on a Schedule C. Well, generally when you sell a single member LLC or a sole proprietorship, it's treated as a sale of assets for federal tax, for U.S. federal income tax purposes. So that in and of itself is going to have some tax implications from a seller standpoint.